Welcome back. As promised, let's invite the management of Nazara Tech. The company has completed the OpenPlay sale for nearly 104 crore rupees to Pokerbazi's parent, Moonshine. To know the rationale behind this development and the outlook, Nitish Mittersain, joint MD and CEO of Nazara Tech, is here with us on the show. Nitish, thank you very much for joining in. First, give us the rationale behind this and how does this divestment align with the company's long-term growth strategy?
Sure. As you know, a few months back, we had bought a significant stake in Pokerbazi, which is India's largest online skill-based poker platform. And the thought of, selling the OpenPlay stake to Pokerbazi is really to consolidate our real money gaming businesses, the skill game businesses under one vertical. The Pokerbazi team is extremely strong, very strong on technology. So we believe that consolidating the RMG business within them makes more sense for us.
How big is the RMG business now for you in terms of overall size? And considering you've always been bullish on it despite all the regulatory headwinds, what is the aligned vision for your real money gaming business under Pokerbazi now?
So Pokerbazi being the dominant player in that space, in that vertical with over 60% market share, is run rating at about, I would say, approximately a net revenue run rate of 600 crores plus. And, will continue to grow very well for us. So the whole idea is that any other vertical of RMG, whether it is open play business or casual gaming, skill-based casual gaming, all of those combined would provide a lot of network effect and lower cost of acquisition. So logically, it makes sense for us to kind of concentrate at one area and focus all our RMG businesses over there. That's exactly what we have done, and I think this will be very fruitful for us.
Is there going to be any other intermovement of your businesses, or has all the RMG been consolidated under Pokerbazi?
I think RMG has been already consolidated.
Okay. And what is Nazara planning to do with 104 crore? I know you're very cash rich. What's the current balance? And now with this incremental 104 crore rupees, what are you planning to do?
Yeah. The balance is quite dynamic because we've been very active in, a lot of investments. We recently announced an investment in a very interesting startup called ReelSaga. We've also placed a pref which is still to close for about INR 495 crores. I think that money will come in the next month or so. But our primary objective will remain reinvesting in organic growth as well as, acquiring interesting companies. Our current focus is on the gaming studio businesses like the ones we've done in the past. And I think in the coming months, we will make more such acquisitions.
What is your current stake in Moonshine? Who are the other stakeholders in Moonshine? And how is the valuation arrived at?
So we hold approximately 47% stake today, but we also have, a CCPS note which we can convert at our, will to, consolidate this business and increase, over 50%. So we will do that at the right time. The other investors largely are the remaining stake is largely owned by the founders.
Okay. And when are you planning to convert the CCPS and at what price? And then your stake would be 51%.
Yes, I think we will, look at it maybe next year. We're not in a very big hurry on that front. We want to give enough room to the team to, grow the business aggressively. At the right time, we will do it. We don't have a specific timeline, but yes, once we convert it, it will be over 50%.
No specific timelines right now. You had earlier indicated about a 10% kind of a revenue growth for FY25. Does that still stand? And you must have drawn up plans for FY26.
Yeah. If you saw our Q3 numbers, right, which we reported in February, our revenues grew year on year for that quarter 66.7%, and our EBITDA actually grew 39%. We posted our highest ever EBITDA of 52.4 crores in Q3 FY25. And this EBITDA is backed with very strong operating cash flows. So I think, we're on the right track and we will continue to deliver healthy growth, in the quarters to come.
And what about the advertising and promotion? That had seen a big jump in Q3. Are you going to continue to press the pedal on marketing? And what's the number as a percentage of sales?
We're seeing very good traction on some of our games internationally, especially west facing into the US. And because these are very profitable spends, obviously, if we can continue to grow it, we will continue to grow. So we don't have a specific target in terms of percentage of spends. The idea is we will continue to scale as much as we can.
And FY26, Nitish, you didn't give us is there a growth number? Is there a top line that you're targeting, margins?
We're in the process of finalizing our AOP right now for the coming year. But I can definitely say that we will be looking at, much more aggressive growth in FY26 over what we have delivered in FY25, both in revenues and profitability.
Aggressive growth in FY26 on revenues and profitability. So we should brace ourselves for margin expansion.
Yes, that's always a focus for us.
Always a focus. In the prior quarter, there was also this one-time impairment on brand scale innovation, wings as you called it. Any such, because we've seen a slowdown in the market, not particularly where you operate, but generally many of the smaller companies are struggling to grow, etc. So are we likely to see any more impairments?
No, I don't think so. All our businesses are working well and are profitable. We are generally a very conservative company and like to clean up our balance sheet, quickly, and which is why we kind of proactively took this impairment of Wings. There is, as we had disclosed in our presentation, also there's an outstanding loan to Wings, which may get provisioned at some point of time, maybe this quarter or next quarter. But generally, we have a very clean and healthy balance sheet.
Nitish, thank you very much for joining us on CNBC TV18. That's the word coming in on Nazara Tech.